Should you leverage using debt when starting out until you reach a point where you are able to do cash purchases, or should you always leverage debt in real estate? It's a really good question, and there's no good answer. It's all about your goals for real estate investing. I have a lot of people that reach out to me. They'll say, hey, how do I get started, investing in real estate? And, one of the things I'll always say to them is, how educated are you? And if you don't know a lot of things, go out and find 20 different ways to get started, and then look at the pros and cons of each, and then back into what you think is the best fit for you. A lot of different people are going to have very different goals when they're investing. If I have $200 million at the bank, or I have $20,000, my goals are going to be very different. If I have $200 million, my number one goal is preserving that capital and not losing it. So I'm going to go for significantly less risky investments. The reason I bring this up, debt is a phenomenal tool for real estate, as one of the few asset classes and investments that debt can be utilized for such a large portion of the purchase without adding crazy amounts of risk. Yes, there's some risk involved, but it's not, unduly or unwieldy. So when you ask me, should I use debt? I'm going to answer by what my goals are. I do not have $200 million. I don't even have $1 million. Not yet, at least. So I am utilizing debt because debt allows you to leverage the property and leverage your returns. Basically what happens is, if you bought a property all cash and it was going to make you, say, 8% on cash flow and sale, hypothetical number, just throwing it out there. If you can borrow 80% of that value at 4%, you're going to make 8% on the 20% that you put down in equity. But then the rest of the money, there's a 4% delta that goes right to your equity, which boosts your returns. So that's why you'll see people get debt, and the more debt you put on something, the higher the returns get. But conversely, the more debt you put on, the more risky it gets, because the debt is the first money out when you go to sell or get rid of the loan. So if you over leverage a property and something happens to the market where values drop, if you got an 80% loan and you have to sell that property for 75% in 3 years of value, you better hope you had cash flow to make it up, or you can come out of pocket, because the bank is taking 80% to get back their money for the loan. If you sell it for 90%, you're losing money on the equity because you're only getting 10%. You're only getting half of the 20% equity down payment you put in. So it is a fantastic tool that'll help you leverage up and increase returns. But you can also over leverage deals. That's why, a lot of times when I'm talking about bridge debt, oftentimes for these deals, we can get 80% of purchase and then 100% of renovation dollars. So our loan to purchase is oftentimes at 100%, or sometimes even higher, depending upon how cheap the purchase is, how much we're putting in. So it really depends. But our loan to cost, you can probably get upwards of close to 80%. We like to be in the low 70s, maybe mid 70s, maybe even slightly under 70, just because we don't want to over leverage a deal and have to hit our numbers or else risk losing money. So debt is a phenomenal tool you don't see in a lot of other places, but you just have to be careful on how you're using it, when you're using it, and what your goals are. If you're very risk averse and you just want to preserve the money you have, go buy a deal all cash, because you're beholden to no one except, your taxes and insurance, basically. Otherwise, there's not really many other expenses, and those should be made up through rent for sure. So great tool, doesn't have to be used, just depends on your personal goals.